So here's what to expect. I've got two folks that are going to really help us through this. On the legal side, Lisa Braganca and Ken Mahoney on the investing side. Lisa, I got to start with you, though. Looks like the empire strikes back. I was reading about potential SEC reforms in FT, and here's a line that struck me. Hedge fund managers fear the painful losses they suffered in the meme stock trading frenzy of January 2021 will be repeated if U.S. regulators press ahead with reforms to security lending, one of the most opaque practices in financial markets. I mean, why hasn't this been done already?
That is an excellent question. It is absolutely ridiculous. I mean, the hedge funds obviously want to maintain this advantage that they have. They like making tons of money on these kinds of trades and not reporting them. And so now their arguments are, oh, well, it would be expensive for us to report. Mm-hmm. Well, stock trades have to be reported, and bond trades and lots of other things. There is no reason to be treating the borrowing and lending of these shares any differently. So, you know, the hedge funds, they're just defending their turf.
Ken, in the meantime, the hedge fund track records have actually gotten worse. They seem to get worse every single year. The vast majority of them a second win, and yet rich people keep paying 2 and 20. Can you explain that to me?
Not easy to explain, but I think it's some type of conditioning, Charles, where you go from like family trust to another family trust, and you know the transfer of wealth over time makes some of these relationships kind of sticky, because it's hard to justify 2 and 20 when the whole model should be blown up. You know, there's no alpha, there's no performance, and somewhere along the way, somewhere along that trust, so to speak, is going to say, wait a second, we're paying 220 and there's no outperformance. In fact, the S&P 500 last year is up 25% for 20 basis points, and you're charging 2 and 20 for 10% returns.
Yeah.
So I think this model's going to turn on its head. But I think right now the reason why we see some of this still is that there are these relationships. They're rather sticky, and they go through generational wealth trust, as I see.
And that explains why Bernie Madoff was able to get so much money and stay viable for so long, right? It was the relationship part of it. Lisa, let me ask you about a poll I saw. It was from Data Progress. So 67% of folks out there, voters, they support a ban on congressional lawmakers from trading, even their staff. This is really huge. The biggest stumbling block is Nancy Pelosi. What do you think is going to happen there?
Well, we've got a number of bills. This is something that just has to happen. There has to be a ban on members of Congress owning stocks. We are in the midst of a whole lot of scandals. We have federal judges that the Wall Street Journal has found, you know, were over 130 of them, handling cases where they had a financial interest. We have over 50 members of Congress who have failed to report trades the way that they should have under the Stock Act. Right. What we have done has not worked. The Federal Reserve is implementing a program now that the judiciary should adopt, and so should Congress.
Absolutely.
And that is no ownership of equities, no ownership of bonds, no ownership of any specialized mutual funds. You get to own vanilla diversified funds, and you got to report any changes that you're going to make in any trade.
And I would go even further than that. If a lawmaker buys $500,000 of a call option, I'm like, hold up, you know something. No one takes that kind of risk. Hey, Ken, I'm sorry we're out of time, my friend. We'll bring you back real soon. Obviously, love having you on. Lisa, it's always a pleasure. Love your judicial insight. Should let folks know you worked at the SEC. You know what the heck is going on there. All right, folks. In the meantime, this market environment.